Hi, and welcome back to Five Big Things for the Future of ESG. For those of you that are new, this series is building off of the Pocket Guide to Combat ESG Skeptics, a resource that we launched to help investors and practitioners push back against misinformation and continue to use ESG to engage in more holistic risk management. Each episode tackles one big shift that we believe will make ESG stronger and more useful. And we've had folks from the Pre-Distribution Initiative, Street Life Ventures, and Freedom Economy join us to talk about workers, climate, materiality, and risk. Today, we're exploring how we can make ESG work for more than just large corporations, companies, and firms. For years, ESG has been distorted by its association with large, well-resourced firms. The better the resources, the better the disclosure, larger the staff, the more sophisticated the reporting. And so we found that ESG scores actually reward disclosure capacity, not actual risk management. In the Pocket Guide, we talk about how those scores frequently reflect the ease of measurement, the completeness of reporting, but they don't truly expose risks. Larger firms have the resources to collect, verify, and publish data, but that doesn't automatically mean that they're managing those risks better. In fact, research shows something slightly more nuanced. A 2024 study analyzing 668 banks globally found that it's actually mid-sized institutions, around the 38th percentile by size, that exhibited the lowest unmanaged ESG risk than both the smaller and larger groups. So in other words, ESG does not only work at scale. There may actually be a structural sweet spot where firms are large enough to manage the risk, but not so large that complexity amplifies that exposure. Which brings me to today's guest. Tracy Gray is the founder and managing partner of the 22 Fund, investing in climate tech manufacturing to create clean, quality jobs in underserved communities while building generational wealth for women and BIPOC communities. Her work sits squarely at the intersection of innovation, capital access, and systems change. Thank you for being here, Tracy.
Thank you for having me. Super excited.
Of course. It's always a pleasure to chat. I have a sneaky suspicion we're going to have to rein it in for time, if nothing else. But we'll cross that bridge when we get there. I think one of the reasons why I wanted you here is because I really do think in this conversation, size has dominated how we think about the most effective and meaningful and resourceful companies. And I think of the 22 Fund as directly combating that perception of what it means to have value in the economy. So for folks that are new to you, could you talk a little bit about what you're building with 22 Fund and then why?
So when you say what we're building, I was like, we already built it, but no, we are building. we are still building because we do want to see systems change. And as a former systems engineer, if part of the system doesn't work, the whole system doesn't work, and we know we're seeing this kind of globally.
Right.
The reason I started the 22 Fund was I wanted two things. For one, I wanted a strategy that was risk mitigated, and two, that it holistically looked at the system. Not these silos of race, gender, climate, economic development, but how can we address them all when I want to address them all? I didn't want to, so I wanted to be able to build a strategy that did that because I didn't see anyone really doing that. I mean, and then personally, I get bored with the same old thing. So copying and pasting what everybody else is doing and just blacking it, pinking it, greening it. I was like, that doesn't sound like any fun. So I really spent time taking all my knowledge from venture and economic development and climate and all the things I'd done that I thought didn't really matter. I just, I thought I was like a dog and squirrel and looking at something new all the time. But it really came together that first, manufacturing is a foundation of our economy. And it doesn't matter what administration, everyone cares about manufacturing because it creates jobs, the jobs stay here. And I saw how much people were paid. They were paid living wages in manufacturing. That's why people stay in those jobs that people think are just don't look great, but they are good paying jobs. Manufacturing is what built this economy. So that's where I was like, manufacturing. It's got to be in low and moderate income communities. You can't have a manufacturer in Upper East Side or in Beverly Hills or in Silicon Valley, right? Can't. So you're already getting that low and moderate income. Then we added exports to help them sell around the world because manufacturing companies that export, they pay higher wages and they're more likely to have health care. And everyone is already here competing against our companies. Yet we don't go out there. So we think we don't have the skills. Well, they're already your competition here. You know how to compete. Now go to their area. So that right there was economic development, job creation, and then climate just has to be horizontal in anything everyone does. I don't care if you're doing only healthcare, consumer products, even defense. It's a national defense risk if our climate, and they know that, right? And that's why we added climate. And then, I keep adding things. Women and people of color, that's easy too, because one, we have the most small businesses. First of all, more women are building businesses, and Black women are at the highest rate. And people of color are the ones who export because they have an affinity or connection someplace else. It sounds like we're doing something complicated, but it's all already exists. So I just put it together. But what I didn't realize, it sounds so complicated. And I'm an engineer, one of my partners is an engineer, so it didn't sound complicated to us. We really needed to educate people more around this instead of just going out and fundraising. And if we really truly believe that this sector of manufacturing is the foundation of our economy, we had to find some money going into them.
What I love about this thesis is that it finds, I think, a very rigorous way to bring these pieces together that doesn't feel like square peg round hole. It actually, the thesis that you described actually makes a lot of sense. This is vital work to the U.S. economy. It's vital workers. It's vital communities. It's vital opportunity. Like you sort of talk about how the thesis makes sense. And I think that that's true because the Venn diagram between all of these different pieces is very close together. I imagine, though, that there is chronic misperception around the value of mid-sized firms or the value of just the manufacturing sector in general. I wonder if you could talk a little bit about that. What do you think is missing when people think about an investment strategy that is not squarely focused on the largest firms in the economy?
It's hard for me because I'm evidence-based and a very logical person.
Right.
But all the evidence shows how important, first of all, 95% of the companies are small, medium-sized companies. So if you take out 95%, what do you have left? You have big companies who are automatically going outside the United States.
That's right.
And actually not just exporting, but outsourcing or just moving to other countries that are giving them these incentives. So if you don't look at the small and medium-sized businesses, our economy collapses. I mean, we have a small business administration, a whole agency for a reason. That under Obama was moved to a cabinet level, and it has stayed there, cabinet level. That's the importance of small and medium-sized businesses. They're also where people build wealth. Right? That is where, so if you, it's just hard for me to, it's just so logical to me. I don't know why people don't take the evidence, right? The evidence is there on how important these are.
Well, and I think that rooted in that is just a misperception around small being a disadvantage. And what I find so interesting in the work that you do, and you've spoken on this before, I mean, these small to medium-sized businesses also have the advantage of being more nimble. They're closer to operations. They're closer to workforce dynamics. When we talk about the hard work of integrating ESG into your operations, if you are small and connected to the work, it's actually easier to integrate these factors into the work that you do. So without building bureaucratic layers, right, which every company is worried about when we start talking about ESG. So I think you're so right that they're critical. And I think there is a misperception. And I wonder if it's a U.S. economy thing or if it's just humans in general, that small isn't quite as powerful. But I would argue that in terms of local employment or regional innovation or ESG integration, they're actually at an advantage. And I wonder if you could speak a little, either through the portfolio or just the myriad experiences you have, how you see ESG factors manifest in these smaller firms versus some of what we've seen larger firms exposed to. What does that look like for you all?
Well, it's what you said earlier. Being small, they're nimble and they're closer to the problems and to the solutions, right? When you have all those layers between you and all you're thinking about is your quarterly returns.
Yeah.
How do you even? That's why those big companies buy these small companies.
Right.
Right. And that's where you're going to also get bigger exits, because if they're acquired, why wouldn't you want that? Also, when it comes to ESG and the risk mitigation, they're already doing that.
That's right.
And you don't have to force them to.
That's right.
We just haven't had to force any of our companies to do it because they see the logic behind it.
Yeah.
We don't even, I don't know if we even call it ESG anywhere in our side letter. We don't even say that. This is just business fundamentals.
That's right.
Do you want proper governance?
Yeah.
Right? And you can't, it's hard, you go back to culture. How do you, if it's bad governance, how do you change it in a large company? We've seen it. How do you change it? And how do you spot it until it's too late? It's hard to spot it in these small and medium ones. If people want to hide stuff, they want to hide it. But if you implement the proper governance, we did a session on governance with all our companies. So there's the G. For S, do you want people protesting against you? Look at Target.
Right.
What happened? That's what the S is, and that was a risk that they didn't take into consideration because they were obeying in advance. Yes. And then environmental, do you want to have stranded assets? Because you can't. So it's like, no. And in these smaller companies, it's easier to explain it to them. It's easier because it's just logic. And when they grow to the big companies or when they get acquired, hopefully that seeps in. Kind of like Ben and Jerry's, what they did. I mean, now it's a little funky, but when they first were acquired, they had to to get Ben and Jerry's, they required you keep their ESG risk analysis, their social impact they want to do, a separate board so they could keep. So, and it worked for a long time until it didn't.
I think what I love about that vantage point is so if there is an investor out there that cares very deeply about the U.S. economy and cares very deeply about impact, then actually part of the thesis that you all are working on very squarely maximizes that impact because of size, not in spite of it. And I think I wonder if that's sort of missing in the conversation too. We've got, I think, a group of investors that are trying very hard to do impact the right way. And we've talked about it as if it's asset class agnostic. And I think that that's true, but I think it's also true that some sectors lend themselves better to it. And I wonder if that's part of what you're seeing even in your own investor base. Do you feel like the investors that come to you live and breathe the opportunity of the impact, or does that actually seem secondary to what they care about?
I mean, it depends, because we have the mix. The only thing we don't have is a sovereign in our fund, but we have, high net worth individuals, family offices, big banks, insurance, foundations. Each one comes to it differently. And I have to say, each one comes to it differently based on the timing of what's happening in the country, right?
Of course,
And a lot of them came during 2020 and 2021 during George Floyd. Before that, it was really tough. Now it's, if we were fundraising right now, it'd be really tough. No one has changed that we have to do impact reporting. No one's changed that. So that's very important to them still. But as we've presented it, there's no trade-off between impact and returns. We do not make any concessions. I'm not saying it's bad. Some people want to do concessionary, but that's not what we want to do. We firmly believe, and the data shows that. So our LPs, and they've really stuck with us through all this. Because our companies it's challenging when they pulled back. A lot of our companies, we tell our companies find non-dilutive funding, find non-dilutive. So they all did that successfully, and then it was ripped from them.
That's right.
Right? And so our and it was really hard for some of them, and our LPs understood that. We are very transparent, very open with the challenges, because why wouldn't you be? Because they're going to find out that sooner or later.
They'll find out anyway. Exactly.
And they're not going to trust you if you don't. So we do that. And they've been very understanding. We've explained to them, people don't really understand trade, really, as we can see from from this country. So once we explain it to them, they like it.
So continuing off of your frame, which I couldn't agree with more, that these small to medium-sized companies are already naturally integrating the ESG because it's just holistic risk management. It's no more or less exciting than that. That's all it is. There's an interesting point here too about you were sort of speaking a little bit about the layers in between where the work happens and where the decisions happen. And in these larger firms, we see that extrapolated further and further so that, you don't always see when you're at the top what's happening at the bottom and vice versa. I wonder whether, particularly on the governance side of ESG, which thinks about responsibility, accountability, fiduciary duty, like you said, I wonder actually if the small to medium-sized company is at an advantage, an operational and an execution advantage to say, we don't have the 17 layers between the top and the bottom. So every owner of this company knows exactly what's happening on the workforce, on the floor, in the community, in the environment. Do you see that play out with your portfolio companies? Do you see tighter communications across the whole stack? I wonder if you could talk a little bit about what that looks like from your vantage point.
So I would say there's the potential for that when you invest because you can enforce it, right? I'm not saying we come into these companies and they're doing it already because they're just trying to run their company, right?
Yeah,
they're
get
not
the work done.
So one of our companies, she spoke about this knowledge transfer sessions they have the first quarter of every year. For weekly sessions. And she says she does that one for knowledge of technology, what's happening, knowledge on how the business runs because she's CEO, but what if something happens to her?
Right.
And also accountability. You can't, her staff can't say, I didn't know that I was supposed to do that. Right. So now, and this was before she had, institutional investor.
Sure.
She had angel investors and they didn't really enforce anything. But once institutional came in, then she had to be accountable.
Yes.
And that trickled down to her. There's sometimes 20, 30 people at these companies.
Totally.
So it's not hard. A lot of times I'm just shocked at what they're getting done with so little staff. And it's going to be less with AI, right? It's going to be even less, fewer people. They'll just shift around, but so one company I know does that. When once you get investment like ours, now if you don't invest, it's not going to happen. Their board meetings change, right?
Yeah.
They have these board meetings, smoking a cigarette, laid back, not really doing the thing,
very
right?
relaxed.
And now, now they're doing the thing, and that's governance. That's they've got to meet certain requirements that we put there, and that we bring it up in board meetings so they don't forget. You can't do that with a larger company. They wouldn't. Right. The board meeting isn't going to you bring that up. They're just going to move on and.
Totally.
So we definitely see it, and we see our. Sometimes we probably are a little too involved with that because two of my partners are serial entrepreneurs. They can do this with their eyes closed, and they can't help themselves. Right. I can pull back a little bit, and I have to kind of rein them in. But they're just they would probably jump in and run those companies if they could, if I let them. Right. So it's that investment and our knowledge transfer that helps these companies. And hopefully they're all going to be big companies located here.
Right. That's right. It's an excellent clarion call, I think, to investors who are trying to find a way. I know I said it earlier, but they're trying to find a way to have impact. If you truly care as an LP about having impact, more and more so, I know I'm preaching to the choir, but investors should be thinking about small to medium-sized businesses in essential markets as the best way to have impact. And not that you don't need a fully diversified approach, we do, but we're not talking about that. We're talking about actually looking at these businesses as competitive advantage, which I think, you live and breathe, but has been missing in the conversation, even if we pay attention politically. We haven't really thought about these companies as market movers. We sort of talk to them as if they're at the little kid table. And I think what we're
Exactly.
hearing is that they are too essential to be at the little kid table. But it takes work. It takes engagement. You have to know what you're talking about. You have to know how to engage with them. But for any investors out there that are listening or paying attention, I think that there's a real opportunity here, maybe to shift the frame, shift the thinking a little bit.
And it's not, I say this, and anyone who knows me, they know I say this over and over again, but this isn't hard. It's not rocket science.
Right.
And I was on the space shuttle program. I know what rocket science is, and this isn't it. But I think people want to make it hard because they really don't want to do it, right?
Yes.
This is not hard. I mean, all investing is hard work. Private investing is hard work.
Yep.
But this isn't any harder than anything. Like, I don't sit here thinking, oh, I wish I would have done just enterprise software companies. It'd be so much easier. No. You're dealing with people, and people are hard anyway.
Yeah.
And there's a whole and there's a whole other thing you got to deal with software. Like now, software is like, oh my God, AI, what is going to happen to our
what
companies?
do we do? Yeah, exactly. Yeah.
So I think if we start just spelling out how it's not hard.
Yeah.
It's not hard. You can do this if you have the experience and knowledge, you do it, but then you've got to, just like you trust people, this is a trust economy too.
Yeah.
Right?
Yeah. That is the perfect segue, I think, to the question that we always want to make sure that we ask, which is, what does it look like to you to know that this work is working? What proof points are you looking for, either tactically or just in the conversation, that gives you the sense that what you just described about just a lack of trust and a misperception of the strength of these types of businesses or manufacturing in general, that we've actually done something to correct that narrative? What would you want to see?
That you and I don't have to have this conversation and pull out our hairs and be so angry all the time, because it hasn't worked yet, right?
Yeah.
We have to keep having these conversations and keep putting out, if we don't have to see another report that says ESG risk mitigation is important, your fiduciary duty, or a report that says you get higher returns with diversity.
That's right.
So I think if we have to stop proving, constantly proving to people what they already know.
Yeah.
I guess that would be success. And then, we have our returns, we have the jobs,
of course.
all our measurements. But I think from a systemic level that I don't have to make the case anymore.
Yeah, I think the last episode we had Erica Seth Davies from Ria Ventures and Freedom Economy here. I know that she's
I'm part of the Freedom Economy.
Yes, I do. We were having that show, and I was about to say I think all of Freedom Economy is just going to be the guest list for this series. That's where we're going. But Erica said something that I know that you and I both agree with, but she essentially said, I'd love for a future where impact investing ceases to exist. I'd love for it to just become the norm. And I think we feel that way about ESG. I think we're having to do this because it feels to some people fundamentally threatening to the way that they view the world. But that's not going to change the fact that the world is changing. So we can continue to be scared about it, but the change is happening. And so I just deeply agree with and mimic that wish of yours and Erica's wish also to say, I do think the future of this is that we actually have to stop talking about it as this nuanced, different approach. We've actually changed the status quo. We've changed the default way that you invest in the space, you invest in companies, you invest in people, and you support them. And we can just stop talking about it altogether. That would be the dream, I think.
100%. I mean, it's all fear.
Right.
And someone said recently, and I've been quoting her, she's head of the human rights department for the city of LA, Capri Maddox, and she said, courage is contagious.
Yeah.
And these companies are hiding, but they're still doing it.
Yeah.
That's what's crazy. So we know, I guess success is the fact they're attacking us, the fact that people are still doing it, they're just not naming it.
Yeah.
So do we want it to be named, or do we want it to be hardwired in the way they do business?
Yeah.
I'm okay with hardwired.
It's a good point, though, right? Yeah, it's a good point. Yeah.
So we get the last laugh.
Good. Good.
That's all I got
good
now.
For you. And, that's good for me and you. I think that's just our default plan anyway.
Yeah.
Tracy, I so appreciate you being here. I feel like there's always so much more that we could talk about, but I am just thrilled that you're able to come and share a little bit about, I think, a piece of the market that really just gets chronically ignored. And I think particularly given the political and emotional environment we find ourselves in, part of what you all have built and are building is actually an answer, I think, to a lot of people's frustration. So I appreciate you for coming and for sharing and for being with us. So thank you.
Well, thank you.